Moving on. Well, welcome to today's session. Must-dos and how-tos of hiring employees, employment law changes, and all kinds of fun stuff that I know is exhilarating to learn about, but I'm excited to share with you. So just so you know who's talking to you and who's on the screen here, I'm Anna. I'm the sales director for Netchex. I am in my 18th year in payroll and HR technology, sales, and I also spent some time in operations. I've been with Netchex about 3 years. I have on here Bradley Kessler, who is on my team. He is one of our senior account executives. He is going into his third year in payroll and HR technology and has been with Netchex a little over 2 years. Um, so the reason that, I think that I am still in this industry is because honestly, of people like you, other small business owners, people always ask me, how did you get into this? And so I kind of stumbled upon it. And what's really exciting is the fact that every day is a little bit different, right? We meet with people and we hear their challenges. And the goal is to say, hey, you got into business for a reason, and that is your why. But then all this stuff got in the way of your why and it becomes your because, right? So you're doing all these different things because you are in business. And it gets you really away from the why you got in business to begin with. And so that's what's exciting about what Brad and I do is our goal is that we can take the things that kind of get in the way and the things that bog you down and to make sure that you're making good choices for your business that you own or the business that you work for so that you can get back to your why. So we're super excited to be here and we just thank you so much for this opportunity. So I'm just going to get started. Like it was mentioned, we'll save questions for the end, but feel free to put them in the chat box and, Brad will be kind of keeping an eye on those to make sure we cover anything that you have at the end of the presentation. So a lot of people say, okay, maybe I've been in business for myself, but I've never actually had an employee. That's a game changer, right? So you've hired your first employee. Now what? So a lot of people think that, hey, I'm a new business owner. I'm going to handle payroll on my own. And I always say, hey, for my kids' birthday parties, I could make their cake, but the middle is probably going to sink in and it may not taste as good, right? So I'm probably going to go to a bakery and have it done because they have the precise measurements that's going to get that cake the way we want it. So a lot of times when it comes to payroll, that's what we're dealing with as well. So there's a lot of things that happen when you hire your first employee. You have to register with your state's labor board, file and pay employer-only state unemployment taxes quarterly. If applicable, you're going to have to register with your state to file withholding tax. You have to file IRS Form 941 quarterly, and then you have to deposit federal and unemployment taxes quarterly. There's also an annual filing of a 940 that has to be done. And so all of these things, whether you have one employee, 20 employees, or 20,000 employees, all of these things have to happen. So I think people have the myth of like, hey, I won't really have to deal with a lot of this stuff until we grow and get larger. No, this stuff comes into effect when you hire that first employee. By January 31st, which is a deadline, obviously, we're coming up upon, Form W-3 has to be submitted to the IRS with Forms W-2 for each of your employees. Something that a lot of you may not be aware of is new hire reporting. So whenever you hire someone new, they have to be reported to the state within 20 days. And they have to be reported, and here's the reason why. So when you hire someone, their social security number is reported. That social security number is then checked to see if they have any wage garnishments assigned to that social. It could be child support, it could be bankruptcy, it could be student loans, it could be a number of things that employee's wages have to be garnished for that. And the employer is actually just as liable, if not more liable than the employee to make sure that employee's wages are properly garnished and that those funds are submitted to the agency that is asking for them in a timely fashion. And so that is why new hire reporting has to be done and done within 20 days of that hire. Unemployment claims, they have to be replied to within 21 days of a dated letter. I'll get into unemployment a little bit more on future slides. What happens if you don't reply within that 21 days is that employee is granted unemployment automatically. There's a lot of unemployment fraud that happens. Social security numbers get mixed up. So a lot of businesses end up paying unemployment claims on people that never actually even worked for them because they didn't reply to the letter. Okay. In Ohio specifically, businesses with one or more employees must carry workers' compensation insurance. So as soon as you hire that first employee, you have to get workers' compensation insurance. Each state has different laws. Um, as you see this chart over here, it shows you what are employee paid taxes and what are employer paid taxes, and there's some that are both. So obviously federal income, local income, Social Security, Medicare are all employee paid. Social Security, Medicare are both employee and employer. And then federal unemployment and state unemployment is paid by the employer only. There are some opt-outs for unemployment if you are a 501c3 or other government businesses that can choose not to pay into the unemployment pool. So you've hired your first employee. Now what when it comes to employee forms? So a W-4 form or a W-9 if it's a contractor is required for each employee. Okay, you must keep it on file for at least 4 years after the date of the employment, after it's paid. Because here's the thing, whichever is later, you're going to have employees that work for you for 1 day, 10 days, 3 years. These are forms that you have to keep on file for at least 4 years, regardless of the length of employment that they were with you. Your I-9 for employment eligibility verification form, you must keep an I-9 on file for 3 years after the date of hire or 1 year after the date employment ends. And a lot of people know that, but what they don't know a lot of times is that the I-9 form has to be kept in a separate folder away from the rest of the new hire paperwork. We see fines in the thousands if you were audited by the Department of Labor and they see that your I-9 forms are being held in the same employment folder as a W-4, a direct deposit form, an employment application, anything like that. They must be kept separate in a folder. Okay. They can be kept all together, meaning you don't have to have a separate folder for every single employee's I-9. You can keep all of the I-9s together in one separate folder. So state required forms. State withholding is not applicable in all states. In Ohio it is, but depending on the state, you have to have a form for local income tax and state income tax. You have to provide them with a notice concerning workers' compensation. You have to provide them with a notice of state disability insurance and paid family leave, a wage theft prevention notice, and a sexual harassment notice. These are all required forms that must be filled out and made eligible at any time to the employee. Direct deposit form. This is something that's optional. There are some states that are called green states where you can require your employees to be fully on direct deposit. There are only 6 states that applies to, Ohio not being one of them. E-Verify. This is not a form, but a way to verify an employee's eligibility in the U.S. And actually on November 30th of 2023, Ohio legislators introduced a new legislation concerning E-Verify. It has since faced many hurdles and is still in the works and has not been approved yet. But this would affect the private sector of having to comply with E-Verify. I don't know if I mentioned this or not, but I'm in the Nashville, Tennessee market. Brad's in Ohio. In Tennessee, a law was passed in January of 2023 that said any employer with 30 or more employees was required to do E-Verify. So that was a huge game changer in Tennessee as that affected, a vast majority of our businesses here. That could be coming for Ohio as well, though it is not passed. An employee handbook. Though this is not a legal requirement on its own, it is a legal requirement for employees to be made aware of company policies, and it can be done through an employee handbook. They have to be made aware. Background checks, drug screens, or alcohol test consent forms, if applicable, those have to be given to them as consent to run any of those checks. Job description acknowledgement. So letting an employee know what their responsibilities are, the goals are of their job, and any performance evaluation criteria. If you're doing performance reviews, what am I judging you on? What am I basing this on? That has to be made aware to the employee. And it's always good to have them sign off on that so that they're acknowledging that they understand what their job requirements are. In the case of termination, if they're being terminated because they did not fulfill a certain duty that was laid out to them in the job description, they've signed off acknowledging that. And it gives the employer, protection that the employee has signed off on that. It also protects the employee as well. PTO policies. So Ohio does not actually require private employers to provide vacation, bereavement, or sick leave, paid or unpaid. But if you do choose to provide such benefits, they must be in compliance with terms that are established within your policy and an employment contract that someone may sign. You may try to recruit an employee and say, "Hey, we are giving you, 10 days of paid sick or vacation or PTO." If that's the case, then whatever is in the employment contract offering that, you must follow those terms and have that signed off on. Regardless of PTO type benefits, employers are subject to FMLA and all of its requirements. Moving on. So, state unemployment insurance. This is something that a lot of people are not aware of, but really should be. It is as a business, it is your only controllable payroll tax rate. In Ohio, the new business rate is 2.7% on a wage base of 9,000. What this means is every employee that works for you, and this starts over annually. So you are paying 2.7% as a new business, right? So someone that's maybe just hired employees, they're going to assign you a new business rate of 2.7. The longer you're in business, that rate could go down. That rate could also go up. But this every business, unless you are in certain industries, you are going to get the 2.7 rate. So I'll give an example. So if you were a 20 employee company, you were going to pay 2.7% of the first 9,000 wages of those 20 employees, which means annually you're paying 4,860 because turnover happens. Let's say 5 of those employees turn over and you have to rehire. That's going to be an additional 1,215. And how I get to that number is if the original 20 people had capped out at that 9,000 wages, which means you're no longer paying the unemployment tax on them the rest of the year, but you have to rehire for those 5, that 9,000 wage base starts over. So you may have 2 people in the same role within the calendar year. So you're really paying that 2.7% on 18,000 wages instead of 9. And that will continue to go up the amount of turnover that you have for various positions. Let's say of those 5 that turn over, 3 of them file for unemployment. Here are some scenarios. The first employee is granted unemployment because the notice sat on your desk too long because, hey, it was payroll week and you were slammed. Just like I mentioned on the first couple of slides, it has to be replied back to within 21 days of the date on the letter. If you do not reply back to it, that employee is automatically granted unemployment benefits. Second scenario, the second employee is granted unemployment because you terminated him based on a duty he couldn't fulfill, but you didn't have it documented anywhere showing that it was part of his job. This goes back to how important job descriptions are to be signed off on, that everyone is understanding what is required of them in that role. Therefore, that employee is granted unemployment. Scenario 3, the third employee is granted unemployment because you terminated her for being consistently late for work, but you didn't have a time and date stamp timesheet to prove it. This is why it's so important to have an automated time and date stamped timekeeping system, whether it be a time clock, whether it be employees clocking in from a computer, anything that shows when they arrived and when they left is super important for many reasons, not only just unemployment. It's also important that if there were, theft at the company, or there was an accident and there needed to be witnesses, anything that happens, it's important to be able to prove who was and was not at work during the time of said event. For unemployment purposes, the outcome of these scenarios, you've been in business for, let's say, 6 months, so you haven't paid much into the unemployment insurance pool. Therefore, the state raises your rate to 3.5% to recoup some of their money. Now, your 20 employees will cost you $6,300 instead of the scenario on the original example of $4,860. So as a new business, unemployment insurance can become very costly if you have a lot of turnover at the beginning and those employees file for unemployment and are granted that, because the state is paying out those unemployment claims to the employees, but you have not paid enough in unemployment to make up for that. So the state says, hey, I've got to raise their rate so I can recoup some of the money that we have paid out. Over time, the longer that you're in business, you will be paying more and more into that pool. Therefore, the impact to your unemployment rate as time goes on would be less significant. Here's the thing, you can also get your rate lowered. So if you really up your hiring practices, your employee engagement, compliance, things like that, you're doing more performance reviews to, hopefully eliminate turnover that could possibly happen. There's a lot of things that you can do to help alleviate the chances of turnover. And so over time, if you're not having that and people aren't, filing for unemployment claims and getting them if they shouldn't, that rate can go down. And so then, in a different scenario, you're saving money as time goes on. So, as this being your only controllable tax rate, it's really important to monitor that. The state is going to send you something called a notice of rate change letter quarterly. Each quarter will say, hey, your rate has stayed the same, your rate's gone down, or your rate's gone up. This is not just assessed yearly, it's assessed quarterly. So it's important to make sure that you are looking at that letter. Whether you're handling payroll on your own or you're outsourcing to a payroll company, you'll need to make sure to adjust that rate within payroll. So if you're doing it yourself, making sure that you're logging in and adjusting that rate if you're using QuickBooks or another platform. If you're using a payroll company, they're going to want you to always send that letter to them quarterly if there's a change so that they can go in and adjust that rate. Because what you don't want to do if your rate's been lowered is continue to pay a higher rate. What you also don't want to happen is if your rate was raised, but it's not adjusted in payroll, over time, the state's obviously going to realize that you were not submitting as many taxes as owed. And then not only do you owe the tax money, then you'll owe, penalties and interest on top of that for those tax monies being late. So I cannot stress enough the importance of unemployment tax and really using that to help your bottom line. So it starts with the hiring process, right? So you need to have fail safes in place to make sure that you're hiring the right people at the right time for the right positions. It could be that this employee would be a great, addition to your company in one arena, but maybe not in the other. So as you're interviewing and maybe they aren't an ideal candidate for the role that they're interviewing for, always keep in mind that there could be other roles within the company that they'd be a great hire for and vice versa. Make sure you have an interview checklist in place, right? So make sure you know the questions that you're asking. Make sure that they are acceptable, legally reviewed questions that you're allowed to ask during an interview, and cover all job requirements because you never want an employee to take a job not understanding what all the requirements are because that is going to raise the likelihood of turnover if they aren't aware. Strictly following the new hire checklist to make sure all policies and forms are signed off on. This is to protect you and your employees equally. Having a new hire checklist that says, hey, I'm making sure I have all these forms in place. I provided this to my employees so they're aware, they've signed off on it. If there's something I need to sign off on, I've done that. You want there to be equal protection between you and the employee. Conducting performance reviews quarterly is super important. An employee needs to know if there's something that they are not doing well, they need to know that. But they also need to know if they are doing something well. Providing employees praise and engaging with them and showing them that you really value their work makes it a higher likelihood of them not leaving and a higher likelihood that if they are considering it, that they're open to having, open and honest conversation with you on things that maybe they're struggling with. This is such a great way, to not only correct things, but to provide praise to employees and really show them that they're a valuable addition to your company. Making sure that you're properly document any warnings the employee may receive. This needs to be done in writing and signed off on both parties, right? Even if it's just a verbal warning, you should document that you've given the verbal warning. Then you can document that you've given the written warning and need to make sure that you are putting that in writing to you and the employee and that it's time and date stamped and signed off on both parties so that any requirements, if there's any follow-up that needs to happen, that both sides are aware of that. If you do determine that you need to terminate that employee, following proper termination procedures, which do differ by state, depending on where your employees are, there's a date of when you must pay them. Some say you must pay them the day of termination. Some say within the week. Some say by the next pay period. So making sure you're following those procedures, because again, terminating someone correctly is obviously the right thing to do, but it protects you from unemployment claims if they should not be granted unemployment. It also protects you from any sort of wrongful termination lawsuits that an employee may file if they feel like they were wrongfully terminated or they were terminated without cause, which some states, you know, you can terminate without cause. But it's so important to have this in place, not only short term, but long term to make sure you're protecting your business. As I mentioned a couple different times, responding to unemployment claims within 20 days of dated correspondence. And it's not the date you receive it in the mail, right? You may not check your mail for a couple days and you open it up. It's whatever date is on the letter from the state. That 21 days starts ticking from the date of the letter. Okay, moving on. There are some payroll law changes in 2024 that are state specific and federal specific. So in Ohio, it's regarding to pay history. So this prohibits employers with 15 or more employees from asking about or screening job applicants based on their current or prior wages, benefits, other compensation, or salary history. Goes into effect on March 1st. So essentially, what this means is during the interview process, you cannot necessarily base what you are offering them as compensation based on what they are currently making. You are not allowed to be asking for that during the interview process and basing anything that you provide on current. For federal, it's rules around OSHA. So the record reporting says, amends record keeping and reporting requirements to require certain employers to electronically submit injury and illness information to OSHA. That has already gone into effect on January 1st. Next thing is joint employment. What defines joint employment under the National Labor Relations Act is that two or more employers will be held to joint employer laws if it's determined that they co-determine matters such as governing employees' essential terms and conditions of employment. So if you have an employee that works at two different companies, but those companies jointly make the decision for that employee, there could be part ownership in two companies, which means that they are going to be determined as a joint employer. That is going into effect on February 26, 2024. So if you're someone that is a multi-ID company, meaning, multiple federal IDs, this could be something that affects you next month. So there are some proposed law changes in 2024 that have not actually gone into effect yet. So some of the things are raising the minimum salary threshold. So increasing the minimum weekly salary for exempt executive, administrative, and professional employees from a $684 weekly pay to $1,059. And, this could definitely impact millions of workers across the U.S. Highly compensated employees, so also known as HCE, increasing the total annual compensation required for the highly compensated employees, going from 107,423 to 143,988. That is a significant jump. Automatic updates, automatically updating earning thresholds within 3 years. So it's saying that with every 3 years, it will be determined if this should be raised. Some other laws that could drastically affect businesses within the state, or is a proposed rule on independent contractors. So a new independent contractor rule under the FLSA may go into effect soon. The DOL proposed a new rule in 2022 that would replace the ruling that happened in 2021 about who is classified as an independent contractor. So this would hold weight in two factors: the nature and degree of control over said person's work and the opportunity for profit or loss to the business based on that employee's degree of work. This rule would help reduce the misclassification of employees as independent contractors, and it will also provide greater clarity to employers who are considering or do engage with individuals who are in business for themselves, right? So on irs.gov, there is a checklist that you can go through that helps you determine if someone is an independent contractor or if they should be paid as a W-2 employee. And there's actually a law that if you kind of raise the flag to the IRS and say, hey, I think that I have actually been misclassifying my employees, I'm okay with you doing an audit to determine whether or not I have, you're going to pay less of a penalty than if you get audited and the IRS determines that you've been misclassifying them and you haven't come forward. So a lot of employers are realizing, hey, if I think I've been misclassifying, I need to go ahead and look at that now and know that I'm going to be paying less than I would be if I were audited. This was submitted and is under review. It was submitted in late 2023. It is still in process and has not been passed. Here are some statistics that really all businesses need to know. 45% of employers undergo a state or federal audit at least once per year. That is almost half of employers are going to undergo an audit. And if you've ever been through one, it is not fun. It is timely. It takes multiple staff members away from their daily job to be able to deal with that, and it tends to be costly. A business that outsources their payroll to a bonded and insured payroll company is 77% less likely to be audited by their state or the IRS. And here's the reason. When the IRS or state sees that your tax monies are being deposited by a bonded insured payroll company, what that says to them is that you're at least trying to do it right, right? You're allowing a company to do this on your behalf, that is their specialty, and they are taking in shared liability. Therefore, they know if they audit you, A, there's going to be less likely that they're going to find a discrepancy. And B, if they do, they're going to be dealing with the tax team of the payroll company versus the business owner or someone in accounting or finance at the employer. Therefore, it's not going to be as easy for them to then recoup those funds. So you're 77% less likely to even have to deal with it. On average, the cost to defend an FMLA lawsuit, regardless of winning or losing, is anywhere between $80,000 to $100,000. That is huge. And to a small business, that could be very detrimental. Of all state and federal class actions filed in the US, 90% of them were wage and hour claims. These were filed by employees that either said they were, um, not paid what they should have. They weren't paid for the right amount of hours. There's a lot of things that go into these wage and hour claims. And of all of the class actions filed, 90% is very high. So you want to make sure that you're doing all the things that we talked about before to protect your business and hire and terminate correctly. Organizations using multiple software vendors to manage payroll, HR, and timekeeping spend 41% more annually than outsourcing to just one vendor. And what this may mean is you may, use a standalone timekeeping system. You may use a standalone applicant tracking system to, post jobs on Indeed, Career Builder, or whatever, but that doesn't talk to payroll. You may be doing, you may have an online enrollment tool for new employees, or you may be doing it on paper. You may be doing your payroll through QuickBooks, or you may be doing your payroll maybe through Netchex, right? So if you're doing it in multiple systems, 41% spend is happening because not only is it hard dollars like paying multiple vendors, it can also be soft dollars too because of multiple points of data entry and multiple people touching all of these things to manage multiple systems versus having it all in one place. If you're doing these things in-house administration of payroll, HR, and timekeeping requires a large commitment of time and resources. It typically costs you around $1,500 per employee per year for a large organization and closer to actually $2,200 for mid-sized organizations per employee to manage in-house payroll. So there's a misconception that you are saving a lot of money by handling some of these things internally when actually you're not. The American Payroll Association, the APA, estimates that automation reduces payroll processing cost by as much as 80%. And a lot of this is due to errors in invoices and paychecks, whether it's over or underpaying based on hours that were incorrect. Different things kind of play into this, but automating these things really will reduce that by 80%. And that's all we've got for today, folks. I'm hoping that some of this information has been valuable to you. I'm hoping that you're leaving today maybe knowing something you didn't know before, or at least highlighted a few things. I hope that you found ways to better hire, better terminate, and better control some of your tax rates.